Hello and a very warm welcome to you. I'm Natalie MacDonald and you're watching another Sydney Direct. On Tuesday, the Reserve Bank of Australia became the 15th central bank around the world to cut interest rates, move towards an easing program or even indicate an easing bias, in a move that Treasurer Joe Hockey says is good for families and the Australian Industry Group says will get businesses investing again. But what happens next? I spoke to Matt Simpson at ThinkForex to give us just those answers. Matt, thank you very much for joining us today. Now, with 69% of economists moving towards a rate cut at the RBA's first meeting of 2015, was it really the shock as has been advertised?
Well, what's particularly interesting about this is it comes down to being an argument between economists versus the markets. The markets are pricing in 69% chance of a rate cut. You looked at the majority of the economists leading into this, they were pretty certain that they wouldn't be cutting rates and it wouldn't make sense for them to cut rates. And there was still an argument for either case of that. On this, in this outcome, obviously the market was correct, but also markets are simply placing bets on the potential outcome. That outcome doesn't necessarily have to happen to make a profitable trade. On this case, I'm sure many of them did.
It's been called a central bank contagion. As I noted, 15 central banks have already acted around the world. How forced, in your view, was the RBA's hand in terms of having to act due to global sentiment?
I would say, surprisingly, it has been forced to a degree. A lot has changed since December meeting they had. We now have 14 banks before RBA to cut rates. Got global growth concerns, and we've also got China growth as well. And unfortunately, whilst everybody else is cutting their rates, it's making RBA look a lot more attractive, the Australian rates look a lot more attractive for yield hunters. So by then lowering that, that's helping remove some of that inflows as well.
The ASX rocketed on this rate call, roaring into a ninth straight day of session gains. Meanwhile, however, the Aussie dollar tanked. Can you walk us through this divergence in performance?
Well, the last time we saw a major divergence between the stock market and the Aussie dollar was actually just as the GFC kicked off. So what happened there was stocks being a risk asset, they declined rapidly. The Aussie dollar being a safe haven, one of the highest interest rates paid at the time, money was coming in. Of course, now we've got the opposite scenario where interest rates are being lowered. It's less attractive to overseas investors to put money into the Australian dollar, seeing the Aussie dollar slide, and currency or carry trades unwound, that is. And at the same time, you've got to put your money somewhere, so we're seeing money go back into riskier assets such as stocks to get a higher return on their investment.
I guess the big question here, Matt, is really what happens next in terms of for both the Australian economy and also for Australian businesses.
Well, for the local currency, it's going to be painting a more bearish picture. So I had an end of year target around 74 cents with a low of 71. We may have to revise that down at this rate that we're going. But of course, it's also down to the strength of the US dollar. I think if the Fed do postpone their rate hike, which I think they will, we'll probably see a little bit of support there for the Aussie against the US dollar. But overall, we should continue to see further downside moving forward. For the economy, this is where it gets really interesting because I'm not entirely convinced that rate cuts are going to give the stimulus the economy boost as the RBA wants it. It's also going to further fuel the housing price, whether it's a bubble yet or not, we will find out. But we can expect highs and prices to go up, but that's not enough to pump up the economy. So how far they'll cut rates, we could even see as low as 1.75 by the end of the year. But I'm still not convinced that it's a good thing for the economy. It's probably not going to send a good signal to the markets about the economy either. And it probably makes us or Australia look a little bit on the back foot. So going to have to keep a close eye on this one as the year progresses.
Matt, many thanks to you taking the time to chat with us today. That is all we've got time for, unfortunately. However, we will certainly be talking to Matt and plenty more market insiders again soon. For now, though, it's goodbye from me.